I'm about to share something you probably won't enjoy hearing. After 4 decades navigating the financial markets, I've seen commodities surge and then plummet dramatically. I've witnessed countless retail traders get crushed, not because the market proved them wrong on direction, but because they nailed the trend while completely missing how the mechanics actually work. And right now, what's unfolding in silver mirrors that pattern perfectly. The stunning climb to $121. The brutal 46% drop to $64 in just 2 weeks. The rebound to $86, the sudden margin increases, and the flood of wild stories spreading across the internet. This stands as the most significant yet poorly understood chapter in the silver market since the Hunt Brothers era. I own silver myself and have for a long time. I'm not here to dismiss the bullish outlook. Far from it, the fundamental reasons supporting silver represent one of the strongest commodity narratives I've encountered in my 40 years of analyzing markets. But I am going to lay out the real story of what took place. Not the tale pushed by those running coin shops, not the account that pins every price swing on mysterious banks and frames every move as part of some grand plot. The actual explanation is both less exciting and more concerning than either of those versions. By the time you finish this, you'll have a clear picture of exactly why silver plunged from $121 to $64 in 2 weeks. You'll grasp what the COMEX figures truly indicate and what they don't. Why the often cited 350 to 1 paper to physical ratio is mathematically off base. Whether COMEX could ever truly default. And the outlook for silver that I consider most probable, drawn straight from the numbers rather than the hype. Subscribe now if you haven't already. Let's dive into what really occurred. Silver reached $121 an ounce back in January 2026. To give that some perspective, the metal had climbed 150% throughout 2025, marking its strongest performance in more than 40 years. By early 2026, it had shattered the $100 barrier for the first time on record. Retail buyers who'd followed silver discussions for years finally felt their patience rewarded. The much-anticipated squeeze appeared to be underway. Physical offtake was exploding. In 1 week alone during January, 33.45 million ounces were pulled from COMEX for actual delivery, about 26% of the registered stock vanishing in just 7 days. Lease rates, which reflect how much big players pay to borrow physical silver, shot up from the usual 0.3%, 0.5% range all the way to 8%. Backwardation, the situation where spot silver commands a premium over future contracts, pointed to intense near-term need. Then, without warning, silver tumbled 46% in 2 weeks, sliding from $121 down to $64. Over those 14 days, COMEX delivered out physical metal, stocks plunged, and the exchange intervened. Margin requirements got hiked sharply. Many participants were pushed into cash settlements rather than physical take-up. Effectively, the system hit the brakes and the price collapsed back to $64. On January 7, 2026, CME Group declared an increase in silver maintenance margins to $32,500 per contract. A later clearing notice from January 30th adjusted parameters from 11% to 15%, with elevated risk brackets rising as well. The impact hit instantly and harshly. Traders holding leveraged long positions, expecting prices to keep climbing, suddenly received margin calls they couldn't cover. They were compelled to sell. That selling triggered more forced liquidation. Algorithms kicked in and sped up the decline. Within 48 hours, months of advances had evaporated. I want to be very clear here because I've observed this exact dynamic play out repeatedly over the years, and every time people misread the takeaway. The drop wasn't accidental, it wasn't some unexplained puzzle, and it wasn't mainly the result of manipulation in the shadowy, conspiracy-laden way it's often described online. Instead, it stemmed from a process I've seen used across every major leveraged commodity arena since I began handling money in the early 1980s. Margin tightening against an overcrowded long position. When nearly everyone piles onto one side of a trade, That side is heavily leveraged, and the exchange lifts the expense of keeping that leverage in place. Participants get pushed out. Not because their view is incorrect, but because they simply couldn't bear the increased cost of staying put. That's the operating procedure. It's spelled out in the regulations. It has always been there, and recognizing how it functions reshapes your entire approach to positioning in this market. Now let's tackle the common misconceptions because they're rampant, and some are causing genuine financial harm. First myth: COMEX is down to just 70 million ounces of silver and is on the verge of defaulting. Here's the accurate breakdown and where the claim goes astray. When delivery happens on COMEX, the physical metal usually doesn't actually shift locations. Delivery typically involves handing over a warehouse receipt or ownership warrant. The bars remain in the vault unless the new holder chooses to remove them. That same receipt can trade back and forth multiple times without any silver ever moving. COMEX tracks silver in two buckets: registered silver, bars actively available for delivery, and eligible silver bars stored in approved facilities by investors or institutions, not currently up for delivery but easily switched to registered status quickly with simple paperwork. As of early February 2026, exchange reports showed registered silver inventories around 103 to 113 million ounces. That's the headline figure fueling the panic. What's left out is the eligible silver in the same facilities, which add several 100 million ounces more. Does the sharp drop in registered silver carry weight? Yes, it does. It signals that demand for immediate physical take-up is running at exceptionally high levels. It shows the system is genuinely strained. The pressure in the paper-silver setup is pushing big investors to seek actual metal, emptying COMEX and LBMA stocks and driving lease rates higher. The stress gauge I track is clearly running hot. But tension and outright failure are not the same. Treating a pressured yet operational system as if it's already collapsed prompts choices that end up hurting the very people who make them. Second myth: there are 350 paper ounces for every single physical ounce of silver. This is the stat I encounter constantly, and I get why it sounds scary. But the math behind how it's derived is flawed. The 350 to 1 number arises from adding up the notional amounts of all silver derivatives, futures, options, swaps, and then dividing by the physical silver held in COMEX warehouses. It sounds shocking, yet it carries almost no practical meaning. Think of it this way, using an example I often share with professional clients. Imagine you own a $500,000 house with a mortgage. Your neighbor carries homeowner's insurance. A bank holds a derivative tied to local home values. A fund has exposure to a real estate index covering your area. If you totaled all those linked financial products, you could easily reach $3 million in instruments connected to that one property. Does that mean your house faces 6 to 1 leverage? Does it imply 6 different parties will arrive claiming space inside? Obviously not. Nearly all those contracts resolve in cash. No one demands the actual house. The identical principle holds for silver futures. The vast majority of contracts close out before any delivery date. Most options simply expire unused. Most swaps pay out in cash. The genuine leverage ratio, the portion of paper positions that could realistically call for physical metal, is vastly smaller than 350 to 1. The realistic figure for potential delivery claims sits closer to 0.01%, or roughly 1 in 10,000 contracts. The deliverable market leverage I actually monitor comes in nearer to 7.1. That's higher than the typical 3 to 4 range, so yes, it reflects meaningful strain worth watching closely, but it's nowhere near 350 to 1. And framing it that way misguides people into unrealistic expectations about an imminent squeeze that might never fully arrive. Third myth: COMEX is powerless to halt a silver squeeze. I need to speak plainly on this, having seen COMEX and earlier exchanges handle situations that retail traders often find upsetting. Knowing their real capabilities serves investors far better than assuming they're defenseless. COMEX can increase margins And they have, 5 times within 8 days back in 2011. In December 2025, they lifted silver maintenance margins from $22,000 to $25,000 per contract, about a 14% jump. Then in January 2026, they shifted parameters from 11% to 15%. Every increase compels leveraged long holders to either add fresh capital or exit their trades. The exchange doesn't require owning physical silver to use this lever. It simply needs to raise the holding cost high enough that most participants choose to sell on their own. They can impose position limits during active trading. They can mandate cash-only settlements in place of physical delivery. They can suspend trading altogether. They can rewrite rules on the fly, just as they did during the Hunt Brothers episode in 1980 by restricting contracts to liquidation only, preventing new longs while forcing existing ones to unwind. The Hunt operation unraveled almost overnight. COMEX isn't a public agency. It's part of CME Group, a publicly traded private company. It sets and adjusts its own guidelines. It has done so historically. It will do so again if it senses any risk to the platform's stability. Does this rule out silver rising further? Absolutely not. Silver can, and I expect it will, climb meaningfully higher over the medium term, backed by solid fundamentals. But the popular storyline of COMEX running dry, defaulting on deliveries, and prices rocketing to $500 assumes the exchange will stand by helplessly and let itself fail. That has never occurred precisely because of the tools I just outlined. Let me now explain what I view as the most meaningful part of the January events from a structural standpoint. A serious financial disruption broke out in the center of global silver trading in Rajkot, India. 44 silver trading companies formally filed for insolvency, facing combined liabilities near $425 million. These were speculative outfits that had wagered heavily on bank assurances regarding silver. When worldwide physical appetite spiked and CME hit the emergency brake, many found themselves trapped on the losing side of the margin adjustments. These Indian firms held paper positions, not actual bars. When the rules shifted mid-game, they were wiped out within hours. This isn't some shadowy conspiracy. It's the outcome of a fundamental gap between what retail players thought they possessed and what they truly held. They purchased paper silver and expected it to mirror physical behavior. When the paper framework was adjusted through margin tightening, their holdings lost value compared to the physical metal they assumed was behind them. At the same time, reports indicated a prominent Chinese trader established the biggest net short position in silver on the Shanghai Futures Exchange. Drawing from Bloomberg figures and analyst insights, that one large short exerted noticeable influence on worldwide silver pricing. Price swings were originating from China as much as from COMEX. The silver decline wasn't a lone incident with one trigger. It resulted from multiple forces aligning: heavily leveraged retail longs in the West, a substantial institutional short in Shanghai, and COMEX's margin hikes that compelled Western longs to unload right as Asian selling pressure hit its height. That alignment triggered the 46% drop in 2 weeks. Importantly, it left the core drivers for silver completely untouched: the industrial needs, the ongoing supply shortfall, central bank and dollarization purchases, and the lease rate strain. Here's how I see the odds shaping up moving forward, and I'll be candid about the unknowns in a manner many silver commentators avoid. Scenario 1. Complete physical delivery breakdown at COMEX, sending silver above $200. I put the odds at about 5%. The strong silver thesis doesn't hinge on turmoil. It rests on proper repricing. Higher prices don't demand an exchange meltdown, and COMEX's available measures: margins, position caps, cash settlements, rule adjustments, trading pauses, make this outcome highly improbable in the short run. Scenario 2. A controlled squeeze. Physical tightness grows. COMEX applies cash settlement and margin adjustments to keep things orderly. Prices spike temporarily to $100, $130 before settling at a higher plateau. Probability: 45% In this case, being correct on direction but mistaken on mechanics can still deliver gains, provided you avoid heavy leverage. Scenario 3. Steady repricing. Silver moves within a $70-$100 band, advancing gradually as the structural supply gap persists. Industrial consumption from solar, electric vehicles, AI data centers, and defense sectors soaks up available metal, while central banks steadily build silver reserves. Probability: 35 to 40%. Less flashy than the second path, but more prone to delivering steady, lasting returns for those with patience. Scenario 4. A deflationary downturn. A recession strikes, borrowing conditions tighten, and risk assets broadly decline. Silver, being roughly 60% industrial in nature, gets dragged down in the sell-off, potentially dipping below $60. Probability: 10 to 15%. This path devastates leveraged players but opens exceptional entry points for those holding unleveraged physical metal with dry powder ready. Across 3 of the 4 paths, controlled squeeze, gradual repricing, and deflationary shock followed by rebound, the key insight stays consistent. Steady, unleveraged holdings in physical silver or solid unleveraged ETFs tend to outperform leveraged paper bets in nearly every case, except the low probability 5% exchange collapse scenario. Let me share what I consider the genuine realities about silver that the popular myths tend to hide. Silver pushed past $90 per ounce in early 2026, thanks to 4 converging structural drivers: a rush from paper into physical silver, China's tightened export policies, growing central bank purchases, and expanding needs from nuclear energy supporting AI and clean power initiatives. All 4 of those underlying forces stayed firmly in effect even after the price drop. China's move to label silver a strategic resource, limiting exports and handling it similarly to rare earth elements, reflects a long-term policy choice based on its importance to industrial and defense needs. That stance won't flip simply because paper prices fell 46%. Samsung locked in an exclusive agreement to take 100% of the production from a silver mine in Mexico for 2 full years. This was a straight physical offtake arrangement that skipped COMEX entirely. Samsung didn't rely on paper futures. They secured actual mine output because they concluded the paper market couldn't be trusted to supply the metal required for their manufacturing. That judgment hasn't shifted due to January's events. COMEX silver open interest fell 31% from its high, reaching the lowest point since May 2012, almost 14 years prior. What does this reveal? It shows that speculative leveraged fervor has been flushed from the system. The vulnerable positions have been cleared. Those still involved now hold stakes they can comfortably maintain. Historically, that setup often sets the stage for the next meaningful advance rather than further weakness. Meanwhile, the physical side continues sending a message different from the paper quotes. Shanghai premiums above COMEX levels have held at $8 per ounce or higher. Asian physical buyers are operating under a reality that Western paper pricing has yet to reflect. Such gaps historically resolve by moving toward the physical level, not the reverse. If you're seriously trying to figure out the smartest way to approach silver at this moment, here's my straightforward advice. First, get crystal clear on exactly what you hold. Physical silver differs from a standard silver ETF. A standard ETF differs from a leveraged one. Leveraged ETFs exist for brief trading swings, not for supporting a long-term investment view. The 46% crash wiped out many who correctly foresaw silver's future path but chose the wrong vehicle to ride it. Your choice of instrument counts just as much as your overall view. Second, the fundamental case for silver stands strong without needing a COMEX default. I get irritated by the default obsession, not because I view the exchange as perfectly trustworthy or the setup as equitable. It isn't. And I've seen proven manipulation cases lead to actual penalties against big banks. But depending on an exchange failure that has never materialized distracts from the robust structural arguments: supply shortages, surging industrial use, dollar alternative buying, lease rate warnings that already make a compelling case for higher prices on their own. Third, your time frame makes all the difference. Those who kept physical silver or plain ETFs through the 46% plunge and are now around $86 sit in an entirely stronger spot than those forced out on margin at $64. Identical outlook, vastly different results. The gap wasn't about smarts. It came down to the tool chosen and the patience applied. To wrap up, yes, silver was driven lower. The drivers combined leveraged retail enthusiasm in the West, heavy institutional shorting out of Shanghai, and COMEX margin tightening that squeezed out the most exposed positions all at once. The difficult reality isn't that manipulation concerns in precious metals are completely unfounded. There have been confirmed cases, including major CFTC actions against JP Morgan's precious metals operations. Banks aren't blameless. Yet the harder pill to swallow is that recognizing those issues doesn't turn paper silver into a secure bet. The process that dropped prices from $121 to $64, margin increases hitting leveraged positions, is fully legal, openly disclosed in the rules and prospectuses, and requires no secret plot. It only needs an overcrowded trade, a leveraged product, and an exchange that raises the price of maintaining that exposure. The underlying case for silver remains solid. Industrial needs are authentic. The supply gap is real. Lease rate signals persist. Dollarization flows continue. The core facts haven't shifted. The physical metal was in demand. Vaults grew thinner. Paper pricing had been disconnected from actual availability. Hold the tangible reality rather than the paper assurance. That's the tough insight that will separate those who gain from silver's coming structural shift from those who lose while waiting for it.